You walked into your bank just to open a fixed deposit. You walked out with a thick folder of insurance paperwork you don't fully understand. Or maybe HR sent you a benefits email with a countdown clock and 17 different options. So you ask around. Your bank relationship manager pushes a ULIP. Your colleague insists you need term insurance. Your uncle swears by a classic LIC endowment plan. They all call themselves life insurance, but these three products operate entirely differently under the hood. You're left trying to compare apples to bicycles. Faced with this, most people do one of two things. They put off buying anything until next year, or they get tired and buy the wrong product just to get the decision over with. We are going to fix this. In the next 5 minutes, I'll give you an objective framework that cuts through the noise and permanently solves your insurance dilemma. Because the truth your agent won't tell you is that this confusion is a deliberate feature of the Indian insurance market. The harder these products are to compare, the more profitable they are to sell. Let's start with term insurance. This is pure risk coverage. You pay a small annual premium, and in exchange, you get massive coverage. If you survive the term, you get 0 rupees back. It functions exactly like car insurance. Then there are endowment plans. These bundle insurance with a guaranteed payout. They sound safe, but they lock your money for 15 to 20 years for a 4% return. That loses to inflation and barely competes with a basic fixed deposit. And finally, the ULIP. Aggressively marketed to young professionals, it promises life cover combined with actual stock market returns. Take a look at this chart representing a 100 rupee premium. When you buy a ULIP, that full $100 doesn't go straight into the market. It runs a gauntlet of fees first. Right away, the insurer deducts a premium allocation charge plus a mortality charge. After that, they apply ongoing fund management charges and monthly policy administration fees to whatever money is actually left. Add all this up in the first 3 to 5 years, and you are left with maybe 60 to 80 rupees actually working for you in the market. The rest is lost to structural fees. Combining insurance and investing mathematically limits your upside. Your returns have to fight their way out of a deep fee hole before you break even. This chart breaks down why you rarely hear about term insurance. On a pure term policy, an agent earns a 5 to 10% commission. But on a ULIP or endowment plan, that commission leaps to 30 or even 40% of your premium. Your relationship manager has a massive financial incentive to talk you out of cheap term insurance and steer you toward the bundled products. When you insist on term insurance, they'll often try one final upsell, the return of premium plan. It plays perfectly to the fear of paying for something and getting nothing back if you live, but it is a mathematical trap. To get your premiums returned at age 60, you must pay 2 to 3 times the cost of a normal term plan every year. If you put that extra money in a simple mutual fund, your final investment would completely dwarf the amount the insurer returns to you. Paying triple for the psychological comfort of getting your money back, or buying a bundled plan because your bank recommended it, primarily funds the seller's wealth, not yours. Let's bypass the sales tactics completely. This logic flowchart uses your specific life situation to dictate exactly which product you need. We start out with one chart and one question. Do you have financial dependents, a spouse, kids, or aging parents who rely on your income? If you're single, debt-free, and no one relies on your paycheck, follow the no branch. You do not urgently need life insurance. Put your money into health insurance instead. But if your family would suffer financially without you, we move down the yes branch to determine your primary goal. If your goal is protecting your family with maximum coverage for minimum cost, you take this path straight to term insurance. The only time you take the other path is if you meet 2 strict criteria. You are in the 30% tax bracket, and you've already maxed out your Section 80C limits via PPF or ELSS. If that's you, a ULIP might serve as an additional tax-saving vehicle. But for 90% of young, working Indian professionals running this exact framework, pure term insurance is the only logical answer. If the math points you to term insurance, execution is simple. Secure a cover amount equal to 10 to 15 times your current annual income, and set the policy duration to end when you plan to retire, usually around age 60 or 65. When choosing a company, ignore the marketing and look at one metric, the claim settlement ratio, or CSR. This is the exact percentage of death claims an insurer actually paid out to families last year. Here is a table of the top insurers by claim settlement. You want a company with a CSR solidly above 95%. As you can see, LIC, HDFC Life, Max Life, and ICICI Prudential all clear a 97% payout rate. But whatever brand you choose, you need to execute now. Term insurance premiums lock in for life based on the age you enter. Every year you delay, the annual cost permanently increases. This graph maps out the cost of waiting. If you wait until you are 35 to buy the exact same coverage you could have bought at 30, your fixed annual premium jumps by about 50%. You pay that penalty every single year for the rest of the policy. Don't sit down with an agent. Go straight to a direct comparison tool. There's one linked in the description below, and run the quotes yourself to see exact premiums side by side. By dedicating 5 minutes today to cut through the noise, you lock in a lower rate for life, keep thousands of rupees out of hidden fees, and secure your family's future on your own terms.